In this video, we're going to talk about some other characteristics of bonds and bond valuation. So let's first start talking a little bit about risk. What is this thing called price risk? Price risk is what we've been talking about when we talk about when interest rates change. When interest rates change, the value or the price of a bond changes as well. If interest rates go up, bond values go down. So in this example here, we can see if we have a 5% required return, in 1 year the bond increased here by was worth $1,048. If it increases to 10%, then the bond goes from 1,048 to 1,000. Of course, the sign is then negative. It would actually go down 4.8%. If it goes up to 10%, goes clear to 15%, the value falls even further to 956, which then would mean a even more, negative 4% more decline. Now, what you'll look here is this is a 1-year change. What about a 10-year bond or a 10-year change? What would happen in 10 years? Well, you can see that 10 years, the price change is much greater than what 1 year would be. So a 10-year bond is much more sensitive to interest rates changes. Therefore, it has what we refer to as more price risk. So if you knew interest rates were going to fall, that would tell you that interest rates are going to, or that prices are going to increase. You would maybe want to go out and buy long-term bonds because you know that they are more sensitive and they are going to increase more than what short-term bonds would do. And we can see this by looking at a graph and the differences in prices, the yield as the yield to maturity changes, and this is the value that changes. This is the slope here represents this price risk. Now, we also can think about something called reinvestment risk. So this just asks the question, what do you do with the cash flows when you receive them as bond payment? So every year, sometimes twice a year, you are paid the coupon. What do you do with that money? Of course, you reinvest it. If you reinvest it and interest rates have risen, then the reinvestment rate has a positive effect on your wealth, right? So what do you do with that? So again, if interest rates are rising, that means future cash flows will earn more money. That is a positive. So what are the conclusions? Well, for short-term or high coupon bonds, price risk is low, reinvestment risk is high. Now, what you might notice here is that these are opposite. When one is positive, the other is negative. So it's way beyond these current videos that we've been talking about, but we might want to be able to find ways to negate some of the bad impacts from interest rate changes and interest rate risk. We had mentioned earlier about semi-annual versus annual. Well, what we can find then, these are the bonds we had earlier in an earlier video, but now we just changed the compound frequency from 1 to 2. It does slightly change the yield to maturity, slightly changes the valuation. Again, this is just because of the time value of money and the compounding frequency. Now, it doesn't change a lot because the only thing that's being reinvested is the cash flows, right? The payments. And the payments are a percentage of the par. So again, yield to maturity, all those things will change. if we compound twice instead of once a year. So if we think about these bonds, and we talked about this a little bit earlier, right? If you bought these callable bonds, would you be more likely to earn the yield to maturity or the yield to call? And again, the question here is all about interest rates. Do you think the interest rates will fall far enough so that the bond price will then exceed the yield to maturity? Because then, since the yield premium, if the bond price is more than the yield premium, it's beneficial for the company to give you the premium and retire the debt. And you can do this if you're familiar with Excel at all. You can use a solver function to solve for the required return or the yield that would provide a bond value equal to the call premium. Again, we can do that. Again, if you're familiar with Excel, it's something that you might want to explore what that yield would have to drop to. We've talked about default risk several times. This is just the chance that the company would not provide or pay the cash flows that they had promised. So this default risk is obviously influenced by the financial strength and the terms of the bond itself, but the financial strength of the company. And there are companies out there that analyze corporate debt and give it, I'm just going to refer to it as a grade. It's called a bond rating. But this rating is based on the probability of default. So the high grades go to those that have the least chance of default. So we refer to these as investment grade bonds. These are the least likely to default. And AAA is the safest of all of that debt. Now, as you move down the scale, we get to riskier and riskier debt. Once you get to a certain point, we start getting to a category where we may start referring to these as junk bonds. These are extremely high risk investments. Now, because they have high risk, investors want a high return. The only way they can get a high return is if they pay very low prices. So these bonds would be very low in price. And we know what? That when they mature, they have to be worth $1,000. The question is, because of their risk, will they get to maturity and you would actually end up with that capital gains? That is the chance you take when you think about investing in these risky kinds of bonds. Now, what are the things that affect the risk? We've talked in previous videos about some ratios, debt ratio, the TIE ratio. You know, how much debt do they have? What is their ability to pay? What's the current ratio? What's the status of cash? But there are also some qualitative factors as well. Is the debt secure? Does it have collateral or not? Is it senior or subordinated? What this means is the first debt borrowed is the first debt that gets paid. So early debt is more safe than late debt. Are there any guarantees? Are there sinking fund provisions, right? What's the debt maturity, right? When does this thing mature? All of these factors are incorporated into the analysis of these companies to determine whether or not or where their rating should be. And again, we talked some other kinds of factors that might also affect default risk, right? Stability of the company, pension liabilities. This is especially for some manufacturing companies. The pension liabilities are huge, and they can really affect the riskiness of the company. What about the regulatory environment? So there are lots of other factors that are what we might refer to as qualitative factors, right? You really can't put your finger or quantify this, but it certainly is an element that affects the riskiness of the company. Thinking of bankruptcy, there are two basic kinds of bankruptcy. Chapter 11 bankruptcy is when the company can't meet its obligations. And essentially what we do, we file for bankruptcy, and there is, if you will, a readjustment of the rules, right? So essentially what we're doing was we're readjusting, or not readjusting, we're adjusting the rules. So creditors may now say, okay, you owed us money for 10 years, we'll extend it to 20 years. Or instead of paying us a 6% coupon, we'll take a 4% coupon. So we'll adjust this, and usually management's going to stay in control. That's called Chapter 11. Now, Chapter 7 is when the company basically says, we're probably worth more dead than alive, so we're going to liquidate our assets. So essentially, the company disappears. So what happens in liquidation? Who gets paid? The secured creditors get paid first. The trustees have to get paid for all their work, so they're in line. Some wages, some taxes, pensions. We're going to go clear down to number 6 here before unsecured creditors get paid. And of course, at the end, common shareholders are at the very end, and they will get something only if there's something left over. Now, reorganization, basically in a liquidation, sometimes the unsecured creditors and people after them get nothing. So reorganization, or Chapter 11, is really what most creditors would rather go for, because at least they'll get some of their money back. So reorganization, or that Chapter 11 process, is really what most companies would like to do if they own the stock, or if they've lent money to a corporation that's in trouble. So the final thing we want to talk here is just the difference between returns and costs. So when a company borrows money from a bank, the interest they pay is a cost. The bank receives a payment, of course, and the interest portion that they receive is the return for their investment in the business. Now, there's obviously a tax thing here, but the point we're trying to make is that the return that investors get is equal to the cost of the company, right? And when you think about borrowing money, this makes sense, right? If the bank tells you you have to pay 5%, you have to pay 5%. You don't pay them 6% because you like them. You pay them exactly what they want. And of course, the bank, or the borrower, since they have a tax deduction, they will adjust their actual expenses because of the tax deduction. So these costs of long-term debt, or how we explain this, is the pre-tax cost is the financing associated with new funds through long-term borrowing. The number we're looking at is the yield to maturity. So the yield to maturity is the return that bondholders get. That has to be the price or the cost that the corporation or the government pays. Now, issuing securities is not free. So we frequently will refer to something referred to as net proceeds. Sometimes there are administrative costs like printing and legal costs. And sometimes for stocks, we might have to lower the price to get them to buy this security instead of another. But those costs are what we refer to as flotation costs. So if the company sells the bond for $980, it may have $10 in flotation costs. So for debt, the flotation costs are typically very low. So some problems will incorporate flotation costs and some will not. So in the end, we have what? R sub D here. This is the before tax cost. It's the yield to maturity. 1 minus T, T is the tax rate. So the after-tax cost of debt is this formula here, right? R sub D times 1 minus T. Now, how we get the R sub D, that we have to incorporate sometimes the net proceeds. So there is a worksheet, and there's some formulas that you can look at that calculate. But we have here are, if you remember, here are our bond variables. The only new variable here is flotation and taxes, of course. Flotation cost and taxes. So in this case, the flotation cost is $20. Price is $980. It's a 20-year bond. 9% is the coupon, 1,000 is the par value, 21% is the tax rate. So what is the before tax cost? It's 9.45%. So this is what it costs the company to borrow this money. Now, they do have a tax advantage, so we can deduct the tax. So the after-tax cost is 7.47%. So the cost of the company after we do taxes, 7.47%. So what we'll find as we're talking about returns and costs, the cost of debt will almost always be the lowest cost. First, because it's typically the lowest in risk, but second, because it also gets a tax deduction. So this is just in later videos, we're going to talk about how we look at financing, and we want to understand how the costs are determined. This will come about in some later videos. Look forward to talking to you soon. Take care.